Mr. Josef Ackermann has been for a long time Chief Executive Officer of Deutsche Bank AG, and in 2012 he left that job in order to become Chairman of the Board of Directors of Zurich Insurance Group. Mr. Ackermann, however, was continuing his job as banker in many international active banks as well as big international operating companies. And as we all have heard so much about necessity to find money to finance the insurance and the health systems all over the world, I think Mr. Ackermann is the optimal choice to tell us about this realm of activities. Thank you very much, Mr. Ackermann.
Excellencies, ladies and gentlemen, when my brother became professor of urology some decades ago, I think the first phone call was to me and said, you have to say a few words and explain to me business administration and what is going on in the global economy. I know that some medical doctors are here, not all of them. There are people from many other sectors of society. But I will try within 20 minutes to give a little bit an overview of what I think is going on in the world economy and what the impact might be on health and of course also on systems in the healthcare. I think the past few years have been, as we all know, remarkably turbulent as we first experienced the most severe banking crisis since the Great Depression some 80 years ago, and then probably the most severe sovereign debt crisis in history. In the process, we have seen some extraordinary, and I would also like to say unconventional policy responses. Governments expended and extended billions of euros, dollars, pounds, Swiss francs or other currency to bail out failing financial institutions and started huge fiscal stimulus programs to fend off a repeat of the Great Depression. At the same time, monetary policy was extremely loose and key central banks entered uncharted territory with large purchases of government debt. Both the crisis and the policy responses to it have changed, in my view, the world we live in. They have shattered long-held beliefs in the efficiency of markets and revealed the need for profound regulatory and structural adjustments. This is not only true of the financial sector, which is already in the midst of adapting to the new reality, including, I would say, something we started in 2007, changing the culture in financial institutions. There is an equally great need for adjustment in the public arena, spanning from global governance to governance and fiscal discipline in the EU, US spending behavior, and structural reforms in countries with generous health and pension systems, but low growth and birth rates, to name but a few examples. Though a lot has already been said about the financial and sovereign debt crisis, I think it is important to briefly highlight some key elements of both crises and the respective policy responses in order to illustrate their impact on the global economy. The period prior to the eruption of the financial crisis in 2007, especially the period from 2000 to 2006, was certainly characterized by a mixture of overconfidence, an abundance of cheap money, and lax lending standards, all of which led households and other borrowers to accumulate far more debt than they could afford. When the bubble burst, real estate prices and prices of related assets in particular crashed, and a growing number of borrowers defaulted. As a result, more and more lenders and other financial institutions got into trouble. When Lehman Brothers became insolvent, the former overconfidence morphed into a complete lack of trust. Suddenly, lenders almost stopped lending to customers and to each other. Companies and other investors stopped investing, consumers consuming, and the entire global economy more or less ground to a standstill. To avoid a repeat of the Great Depression and to restore confidence and growth, governments dramatically increased spending, bailed out banks, and tightened financial sector regulation. These measures calmed markets and reanimated economic activity, but they also shifted the debt problems from the private to the public sector. Since many countries were already highly indebted at the onset of the crisis, their debt levels became unsustainably high in the process. This was especially true, as we all know, in the Eurozone, where some countries on the southern periphery were hit by a severe loss of investor trust and dramatically rising refinancing costs, and were consequently forced to administer fiscal austerity programs. Less government spending, higher tax rates, and a reduction in the capacity of banks to provide loans due to their own need to deleverage continue to weigh heavily on those countries' economies and to hamper the economic recovery in Europe. To foster economic activity and to lighten the public debt burden, central banks loosened the reins of monetary policy and intervened in unprecedented ways. They not only lowered interest rates to close to zero, they also ventured into uncharted territory by purchasing sovereign assets and debt. That way, they took on the debt burden from the public sector. By now, the deleveraging process is in full swing. In the United States, private sector debt has already fallen significantly. The housing market has started to stabilize. In Europe, public debt reduction is well underway. In addition, the weaknesses in the institutional structure of the European Monetary Union are being addressed. Crisis-hit countries have also improved their competitiveness through labour and much lower labour costs. Overall, countries have started to apply the right therapies. But it will take quite a while and some more bitter medicine before the world has completely recovered from the two crises and returned to a healthy and stable growth. Policymakers, financial institutions, and private households have to continue to reduce debt to manageable levels. The big question is how far spending can be cut without killing revenues, and how far and for how long interest rates and financing costs can be reduced without creating inflation. If you are to avoid a recession and thereby a severe reduction of tax revenues and a further aggravation of the debt problem, fiscal austerity must be coupled with growth-inducing structural reforms of labour markets, education, and welfare systems. Financing costs will only come down when the markets believe in them coming down. Investors must have trust in the success of the deleveraging and growth-fostering efforts before they will be willing to provide funding at lower risk premiums. And only when risk premiums come down will it be possible to reduce debt levels. Central banks are supporting efforts to bring down financing costs through accommodating monetary policy and targeted bond purchases. However, this is not without risk. To prevent inflationary expectations from rising beyond a certain level, they need to pick the right time and muster the necessary political resolve to withdraw monetary stimulus measures, which is politically, as we all know, no easy task. In the end, highly indebted countries have no choice but to convincingly show that they are able to get a grip on current expenditures and also on future spending, such as the rising costs of pensions and healthcare, for example, if they want to maintain or regain access to capital markets on reasonable terms. The trick here is to convince investors and their citizens at the same time. Administering harsh fiscal austerity measures in economically tough times is a very challenging political undertaking. The process entails painful sacrifices and, if not handled dexterously, could lead to dire political outcomes. Besides continued debt reduction and growth fostering structural reforms, a sound, well-functioning financial sector is vital to any recovery. Without that, it will be difficult, if not impossible, to return to healthy growth. And it will be equally difficult, if not impossible, to find solutions for the growing pension and healthcare problems of societies with a shrinking workforce and a rising number of elderly people. State-sponsored social security systems have reached their limits here. A sound and well-functioning financial sector requires well-designed regulation which prevents exaggerated risk-taking, but at the same time doesn't overly restrain the activities of financial services providers in the process. My feeling is that in their well-intended efforts to make the financial system safer, authorities don't always pay enough attention to the growth effects of their combined regulatory changes. Now, what are the implications of all this for the global economy? It is highly likely that we will have to cope with several years of low growth in most developed countries. However, I expect that low or even negative real interest rates will help countries with high debt to gradually reduce debt to sustainable levels within the next few years, without further major financial or economic disruptions, providing for new growth opportunities in the years afterwards. In the near future, however, fiscal austerity is bound to limit economic activity, especially here in Europe. Some European countries will likely remain in a moderate recession until the end of next year. On the positive side, one can note that the debt crisis has revealed many weaknesses, both within individual European countries and the architecture of the Eurozone, which are now being tackled. I'm confident that in the end this will lead to a return of confidence and growth and make Europe stronger than before. While the US economy looks in better shape than the European economy at present, one must bear in mind that its growth still depends heavily on fiscal and monetary stimulus, which will have to be withdrawn at some point. The US Congress has as yet failed to agree on much-needed long-term deficit reduction. This is increasing uncertainty and hampering economic activity. Hopefully, this problem will be attacked after the upcoming elections. Japan was not directly affected by the housing and debt crisis this time, but as a result of the weakness of the euro and the US dollar. The yen has gained in value, and Japanese exports have become less competitive. For an export-oriented country like Japan, which has never really recovered from the downturn in the 90s, this is a heavy burden. Growth in Japan is therefore likely to remain anemic for the foreseeable future. According to the latest estimate from the IMF, the Chinese economy will grow by around 7.8% this year and 8.2% next year, compared to the double-digit growth rates of the past. But fears that the second biggest economy in the world is in for a hard landing seem exaggerated to me. China is in large parts still a developing country and therefore has plenty of room for further strong growth. In addition, unlike most developed countries, China still has significant potential for fiscal and monetary stimulus, which, if need be, it would certainly use to prevent a politically harmful deterioration in its economy. Besides China and Asia as a whole, Latin America has been one of the key growth drivers of the global economy in recent years. Latin America countries also have great potential for further growth. The main risk here is their dependence on commodity exports and hence on falling commodity prices as a consequence of reduced economic activity in the US and Europe. Although there are some bright spots in Africa, this continent unfortunately still remains much too weak to contribute significantly to global growth in the foreseeable future. Overall, as a consequence of the two crises, we can expect that the shift in the balance of economic and probably political power in the world toward the so-called emerging countries will accelerate. Ladies and gentlemen, as you all know, there is no cure without pain. For many years, large parts of the Western world have lived way beyond their means. We enjoyed the good times while they lasted, and now we have to pay the price and endure a number of years of austerity. The faster we accept that simple truth and act accordingly, the sooner we will see better times again. Thank you.